Hi, and welcome back to Systematic Investing with JioBlackRock. Today, I have Rishi Kohli, Chief Investment Officer for JioBlackRock AMC, for a three-part conversation. We're going to talk about how the Flexi Cap Fund is performing. We're going to talk about the new NFO, the Sector Rotation Fund, and finally, how does an investor pick between the two? Rishi, welcome to the podcast.
Thanks, Rahul.
Rishi, the last time we spoke, we were amidst our Flexi Cap Fund NFO. Can you share with our listeners how did that NFO go and some current statistics around it?
Sure. So in the NFO, we collected just under 1,500 crores, which was quite encouraging given that it was direct and digital. Because as we all know, in the last few years, active equity funds, the better fundraisers have been in the 3, 4, 5,000 crore range. But most of them, 90 to 95%, is from distribution. And only that 5 to 10% is from direct, whereas ours was entirely direct. So I think, we were pleasantly surprised, as well as the industry took notice of that. But interestingly for, I think, me and the top management, what was even more interesting has been that daily we've been, seeing flows since then. It's past 3 months now, and we are still continuing to see healthy flows, and therefore currently the fund is just under 2,600 crores. Which is a large growth that has happened in these 3 and something months. So that is very interesting. The second interesting statistic is the number of customers, which is more than 7 lakh customers now in just the Flexi Cap Fund. And overall, of course, on the mutual fund, across all funds, we have more than 10 lakh investors. And interestingly, 18% of them are first-time investors in mutual funds, and largely driven by the Flexi Cap. And a little bit in the equity index funds. So those are very healthy, very encouraging numbers, given that, the equity index fund started only in August and the Flexi Cap Fund a couple of months later. So these are very interesting stats from the investor perspective, the fundraising, etc. And then, of course, going into the portfolio and numbers around that, what has been interesting is that everyone was interested in knowing whether, we will be true to label, whatever differentiation we were talking about, how will that play out in real time, because finally simulations and backtests and global performance is a different thing, but how will it pan out in India? So the good news is that in these 3 months, and obviously because I look at the data very closely on a day-to-day basis, since the volatility of alpha and the active risk and all of that is very important for us. So everything has largely, been sticking to what we had promised. So the active risk is consistently on the lower side based on the numbers and the models that we see. The volatility of alpha is very low. So for example, 25 bips negative alpha relative to the benchmark is a bad day for me, right? Okay. So that is sort of the higher side of the downside deviation of negative alpha that we've seen so far. So that 20 to 30 bips number is like a large day. Obviously on the positive side also, as we had said, it'll be small, but it'll start adding up over time. So again, over the 3 months itself, we've seen it adding up, and the numbers are out there for anyone to see. But at a high level, we had said that largely we'll try to be in Q1, Q2, and that consistency itself, if maintained for 3-4 years, will get you to being among the top few funds. And interestingly, so far, we have been in Q1 or the top of Q2 quite consistently over this period.
Very interesting, Rishi. And firstly, congratulations. I think the mission and vision which JioBlackRock has is to, make investing more accessible, make investing democratized. And the fact that you've got 18% of your investors are investing in mutual funds for the very first time is very promising. And I think you also mentioned that the volatility of alpha has been very low. Now, what I found very interesting, Rishi, is I was going through the 3 months fact sheet which you published, and I found that the top overweights and top underweights at a stock level kept changing every month for the Flexi Cap Fund, which is sort of what you expect from a systematic portfolio, right? I think a lot of what you said, it's benchmark aware, so you don't see it deviate too much from the benchmark. The returns also closely follow the benchmark, but do outperform it on a consistent basis. Can you tell us how this approach is different from a fundamental approach? Like, to our listeners who are just tuning in, how is a systematic approach very different from a fundamental approach?
Yes, sure. So, to recap on that, on the systematic side, obviously we are following the process in a completely disciplined manner.
Yes.
So, it's largely rules based. Obviously, there are places where the fund managers can intervene, but that is more from a risk management perspective. So, for example, in Flexi Cap, we have very tight sector bounds and stock bounds relative to the benchmark, and those are small ranges, typically 1.5 to 3% on the stock side, similar on the sector side. There, of course, if some risk events are there around some sectors or some stocks,
Yes.
then the fund managers can step in and tighten those bounds, for example, right? So those kind of risk management interventions. Then we have a corporate governance screen. There also it's partly automated and partly a manual decision. So some of these from a risk management perspective is where the fund managers come in. But other than that, the data that we are using, the signals from there, which metrics we want to give importance to, not give importance to, what weightage those signals have, all of that is predefined, and the process will follow that rigorously every week, right? And secondly, it's a weekly rebalancing process in Flexi.
Yes.
Which is again very different from the rest of the market. So both the systematic element where it's largely rules based, the sector stock bounds being very benchmark aware and therefore having narrow constraints around their weights in the benchmark. These are all things which are very different from a fundamental approach. Of course, on the signals being used, they are largely fundamental. But then again, things like, let's say, analyst sentiment.
Yes.
On a fundamental analyst or a fund manager would be reading all those reports, assimilating it in whatever experience and manner they have, and then making some meaning out of it. We have obviously systematized the whole process even on that side. So we feel that we're not really missing out anything, because in today's world, of course, even the management meetings and quarterly conference calls and related things that happen, you can easily have AI ML running on that and giving you the inputs, and therefore we are able to capture everything that we want. And of course, on the fundamental side, anyway, all the data is available, and we are sticking to whatever signals and the weighting that we have.
Rishi, I think that's very comforting as an investor to know that, whatever you said, and we have a whole video on, what our Flexi Cap fund does, the process is actually working. When we look at you delivering exactly what we spoke in terms of, the number of stocks, in terms of the active risk of each stock, the risk of the portfolio, the fact that it is benchmark aware, the fact that performance is going to be, your aim is to deliver consistent alpha across a large number of stocks and not take single bets driving entire portfolio performance, is very comforting as an investor to see all of that play out. Rishi, now when we think on the other extreme, right, I think a lot of questions we've got around is that you're holding a large number of stocks, 120 to 140, 160 stocks in some instances. How does this differ? How does a systematic strategy differ from an index approach?
Yeah, so see here, finally the benchmark is Nifty 500.
Yes.
And we are choosing, let's say, around 140 stocks right now.
Yes.
So firstly, obviously it is sort of 1/3 the number of holdings. It's not all the holdings. And then on each of them, there is a very active weight that is there, right? So almost nothing is exactly as per the benchmark. While we say there is a tight range, for stocks typically between ±2, for sectors ±3. Typically, it can be slightly smaller or slightly larger depending on the period. But
this
those
is for the Flexi Cap fund.
Yes, but those are obviously narrow bounds for people, and therefore it is easy to think that it will be similar to the index. But firstly, it's 1/3 the stocks. Secondly, if on every stock I take a very active overweight, underweight, then collectively that becomes a very massive bet you're taking, even though there are 130, 140 stocks, and that reflects in the active share, right? Because the active share for our Flexi Cap fund is not very different from all the other very active fundamental funds out there. So I think that is an easy metric, since in India, investors, advisors, everyone has been looking at active share. It's a very commonly discussed term. So I think that is one thing which can dissuade that query that many people have.
It is not a buy and hold strategy like how an index rebalances, say, with whatever frequency.
Correct.
This is more active. One, the view on each stock is very active. It keeps changing more frequently, and that helps you capture alpha.
And then weekly rebalancing is happening. So like you said, right, the overweight, underweight names have changed every month. In a lot of cases, they've been changing every week, which obviously is not data we've been sharing, but internally the process updates every week. So obviously that dynamism is what helps, because finally in a systematic process, what the math shows is that small alpha will build up over time. So the more number of bets that you take, it helps to compound that alpha more meaningfully in the long run. And therefore, that active overweight, underweight changes happening, especially on a weekly time frame, is the better approach.
And intuitively, that makes a lot of sense, Rishi, because like the data which you get, it keeps changing every day. So your portfolio will change based on your rebalance frequency.
Especially the alternative data, right, which is the key differentiating factor for us in that fund compared to everything else out there in the market. That is something we are getting on a real-time basis or a daily basis.
Yeah.
And therefore, that data is really stale after a month. But on a weekly basis, at least we give it some chance to change whatever weights it wants to while we run the process. And that is why it is important to have it.
Fascinating, Rishi. Rishi, can you set expectations from the Flexi Cap Fund for the next 12 to 24 months? Can you talk a little about how the portfolio is designed and what should an investor's expectation or experience from investing in this fund, what would that look like?
So I think much of the same. Consistency matters, more than being the best in different patches, but then also taking the volatility on the downside. That is how the process has been designed. As we discussed, the first 3 months have gone exactly like that.
Yes.
Of course, it'll vary a little bit. We haven't seen the worst patch because it's been a very short period. I'm sure we'll see our worst patch, our best patch over the next 3-4 years. But overall, if it follows what I'm saying, then I think it'll end up doing what the objective is. And I would expect largely it to follow that, because as the CIO, when I'm looking at some of the data daily basis or intraday or whenever I get the time, there are these things that I track, which is whether the factor exposures are very low, because we said we want to neutralize that, as that gives more volatility, majority of the risk, and therefore the alpha is coming from the stock selection, because Flexi is a bottom-up stock selection process. So those numbers are there on a daily basis. So apart from the low volatility of alpha, these are the things which on a daily basis, give us a lot of comfort. And therefore, that is clearly very repeatable process and will continue for the next 2, 3, 5 years, forever, as long as we run the fund. So I think that investors can definitely expect to happen very smoothly. And our belief and objective obviously is that if that happens, then we'll end up, delivering what we've said in the past.
Got it, Rishi. So I think what I'm taking away from this is that as long as the model works, you will see yourself being in Q1, Q2 or the bottom of Q2 in a very bad scenario, and you being consistently in, say, the Q1, Q2 phase automatically over a period of time helps you compound and move to, say, the top decile in some instances. Got it. Rishi, and final question on the Flexi Cap. We don't want to spend too much time on the Flexi Cap for this conversation. To a new investor who's evaluating the Flexi Cap fund, can you explain the investment process from the start to the end? Like you start at 1,000 securities and how do you reach the portfolio?
Yes, so 1,000 securities is what we have as coverage, as we call it internally at BlackRock and now at JioBlackRock. Out of that, of course, the MSCI Larger Universe Index is for India the top 750 stocks. So for the Flexi Cap, we start at that 750 stock universe.
Okay.
The benchmark is the top 500 stocks because it's Nifty 500. But we keep the 501 to 750 because some of those stocks are going to come in the Nifty 500 over a period of time. And the more live data we get, obviously the models improve, they give you better signals, we get more history, all of that. Secondly, we have a lot of liquidity data, impact cost data on the 750 stocks because globally BlackRock at different points in time has been running between 50 billion to 100 billion on that MSCI India index.
Yes.
And that means that, whatever analysis we need to do and the data we include in our processes, I'll just explain in a minute, using that cost and liquidity, that is already there with us, which is not necessarily the case with everybody. So because of those two reasons, we have that 501 to 750. But just based on the weighting methodology that we have, obviously, the weightage on that 501 to 750 names will be maybe 2-3% at different points in time. So it's very small, but I just wanted to explain that, we will have some weightage there, unlike many other funds.
Which makes sense because you're a benchmark aware strategy. So when a particular script is not in the benchmark, but you have it under evaluation, you're not going to see it deviate or the active share of that's not going to be too high.
Too much, yes. And then the main process, again, focusing on the 500 stocks, of course, there's a governance screen, which is a little bit of a model, but a lot of it is sort of discretionary, where the chief risk officer and the credit research team and the fixed income team help us because they are more attuned to all the corporate governance and credit risk kind of issues. So that is again a list of 25 to 30 stocks where we don't eliminate the stocks like what many other funds do. But what we say is that, we won't let it go overweight. So if the model says go overweight some of those stocks, then we'll let it go to only max benchmark weight.
Okay.
But if the model wants to go underweight those stocks, then we'll let it go to whatever underweight it wants to go to.
Underweight to benchmark weight for the corporate governance screener.
Yes. So that, and then finally, of course, we have the alpha scores, right?
Yes.
So we have all these buckets: value, growth, quality, sentiment, momentum, all of this. And based on that, there are about 35 signals at different points in time over the last few months.
Okay.
Each of them have certain weightages. So we get weighted average alpha scores. And as a result of that, we have an alpha score for each stock. Then we have a corporate governance screen where there are about 25 to 30 stocks currently at different points in the last 3 months in the screen, where we take help from our chief risk officer, the credit research team, and some fixed income people apart from that also in the team.
Yes.
And how we use that is that if the model wants to go overweight some of those stocks, then we won't let it go overweight. The max weight it can go is the weight they have in the benchmark. But if the model wants to go underweight some of those stocks, obviously we'll let it go to whatever underweight it wants to go to. That is how we're using the corporate governance screen.
So you go underweight to benchmark weight. Got it. Okay.
And then the main part of the process is obviously the alpha scores, risk scores, and transaction cost model. Alpha scores is the thing which I think everyone in India, sort of focuses on, because it's in some sense your relative return expectations of stock A versus all the other 499 are in the benchmark. For us, there are multiple buckets we have, and that is like value, growth, quality, sentiment, things like that. Of course, there is alternative data also that we have, which is there across all the buckets, but you can think of it like a separate bucket. And across all these buckets, we have around 30 to 40 signals, as we call them.
Yes.
Collectively. Each of them, based on their past efficacy and whatever research we've done, have a certain weight. And obviously those weights add up to 100. And therefore we will have an alpha score for each of the signals, and then we'll have a weighted average alpha score for each stock.
For each stock.
And that alpha score for each stock becomes its relative return expectation or relative attractiveness compared to the other 499. Now, as I was saying, that in India, typically, whether you have a fundamental process, a technical process, a quantitative process, that is largely the alpha scores or the relative return ranking is what people focus on. Interestingly, at BlackRock and at JioBlackRock, we also have our own risk model, right? So BlackRock has it at a global level, BlackRock risk model. The team here, converted it into a BlackRock India risk model. So we get a risk score also for each stock. And then finally, we have the transaction cost model and liquidity analysis, which is basically your impact cost slippages when you trade on each stock. And then the liquidity, how if you are 10% participation or 30% participation, how does that impact cost slippage change?
Yes.
How much does your, overall participation in the strategy change, etc. So for us, the final step is that these scores come out for us, and then they all go into an optimization engine on Aladdin. Which then throws out the final most efficient group of stock portfolio, so group of portfolio of stocks and the weightages of each stock, which is therefore cost controlled, cost optimized, risk controlled already, right? And then this whole process gets updated on a weekly basis, which is the weekly rebalancing we were talking about.
Got it. So I really like what you said on this, Rishi. Alpha, risk and cost is what goes into the optimizer, and every time your portfolio comes out from the optimizer, it is already controlled for both risk and cost.
Correct.
Rishi, let's move on to the second part of this conversation. You recently announced your sector rotation fund, the JioBlackRock Sector Rotation Fund. This will also be a systematic active equity fund.
Yes.
Let's start at the top, Rishi. What is sector rotation and why is it important?
Sure. So, see, firstly, it is important because globally research shows that there are only 3 pure sources of alpha.
Okay.
One is stock level, the second is sector level, and the third is factor or style, right?
Okay.
Now, stock level is what we are doing in Flexi Cap, for example, and what majority of the industry in India does. Because in different ways, in different categories, you're actually focusing on stock selection and thereby the alpha that comes out.
Yes.
But the second level of alpha, which is sector focused, which means that by selecting the right sectors at the right time, or by moving weights across, the right sectors at the right time, you can also have a different source of alpha completely, which is not correlated to what you're seeing on the stock
level.
selection alpha.
Okay.
So therefore it becomes very, very important. And then coming to, what we mean by sector rotation really at our level, because I think the terminology sometimes locally, people would think that sector rotation means that we will have only a few sectors at any point in time, because that's how locally discussions have happened around sector rotation in the past. For us, it is obviously a diversified approach.
Okay.
Similar to Flexi Cap, which is a diversified approach on the stock side. Here it is a diversified approach on the sector side.
Okay.
And the stock portfolio that comes out of it is largely driven by that sector selection or the weightage changes that happen. So starting from the high level, the typical sectors we all talk about, financial, auto, that is what globally under GICS industry classification is level 1 or L1. When you go to L2, level 2, there are currently around 25 sectors. Obviously that can change, lower or higher depending on how that GICS industry classification changes over time. But currently it is around 25. So out of that, around 18 to 19 typically, and again it can be a few lesser or a few higher in extreme scenarios, but typically 18 to 19, the model does give weightages to at any point in time.
Okay.
So that's why I said diversified group of sectors, because it's not like choosing 4 or 5 out of the 25. It is 18 or 19. But the interesting thing is we are going to that level 2 level of detail, because again the industry largely does not do that. And how it helps us is that an easy example is financials.
Yes.
Right. Financials includes banks, NBFCs, insurance companies, capital market plays. Okay. And all of these sort of subsectors, if you want to call it, are very different from each other. And will have, some different signals also that you want to use. And even the ones that are common that you're using, you can't compare, one bucket to the other. So therefore it is important to go down to that level of granularity and do the analysis at that level 2 level. So which is why we are doing that. And then once the sectors are chosen, then again the overweight, underweight is driven by a similar analysis on the alpha scores, similar to Flexi Cap. But here obviously it is top down, right? So Flexi Cap being stock alpha focused was bottom up. Here because it is sector alpha focused, it is top down, meaning that the overweight, underweight signals are coming at a sector level.
Okay.
And then the sector bounds that we have, which in Flexi was very tight, here it is much broader because it is the sector alpha that we are focusing on. Over time, 90 to 100%, so something in that range, probably on an average around 95% of the alpha that we will see in the long run will come from sector overweight, underweight. So therefore that is important. And there largely, it is a plus minus 10% kind of range at that level 2 level, right? So at a level 2, obviously banking has a slightly larger weightage, but all other sectors would be, 7, 8, 10% kind of weightages and lower, of course. So in that, something that has a 10% weight could be 0 and it could be 20 as well. So when you have 18, 19 of those level 2 sectors, and then each of them has a plus minus 3, 5, 10% overweight, underweight, it is not difficult to understand that it will be a very active fund. Therefore, the rebalancing will be monthly. So here again, because it is more sector focused, for sectors, the data and the importance of that data is not changing on a daily or a weekly level. So it is more monthly and bi-monthly and quarterly that important data comes. And therefore, it is a monthly rebalancing process. So as, I and other senior people in the firm have said earlier, that the rebalancing and the overall process is designed as per the product and the objective that we have. So here, because it is sector focused and sector data changes at monthly and longer time frames, so therefore there is a monthly rebalancing process.
Got it. Rishi, so a lot to uncover here. In fact, you've already addressed the next couple of questions which I had. What I really liked is what you said, that the 3 types of alpha, which is your stock specific, sector specific, and style and factor specific. The Flexi Cap focuses on stock specific alpha, while the sector rotation focuses on sector specific alpha. And you look at sectors as 25 different, at an L2 classification, which has 25 sectors. At an all points in time, you have 18 to 19 sectors in your portfolio. I think very different approach from what's available out there. Rishi, I read that the sector rotation fund will also be systematic in nature.
Yes.
Can you tell us which signals rules will be different here compared to the Flexi Cap?
Sure. So in this fund, there are 5 buckets,
Okay.
which is first is valuation, then is quality and growth sort of combined together because we're taking a few metrics from each on a combined basis. Then we have sentiment,
Yes.
which is around analyst estimates, target price changes, all of that. Then we have momentum. Momentum is again things like industry momentum. So there's a lot of global research and things that I and other team members have done for India also in the past that actually a lot of industry level momentum supersedes the stock momentum. So if you can do the industry momentum correct, actually your stock momentum is a outcome of that, right? So that is important. And then seasonality kind of things, because again different sectors will do better or poor in different points of time, and there is some seasonality around it in terms of business and quarterly results and other things. So that also goes into a momentum bucket. And the fifth, which is very different, because the first 4 there will be some overlap of signals with what we have in Flexi.
Yeah.
But then again we are accumulating some of that at a sector level, or if some of that data is there at a sector level, then we are going from a sector level down, not the bottom up approach as in Flexi. But the fifth is something which is completely different because it is a macro bucket.
Okay.
And obviously the macro bucket matters for industries. It may not matter so much for stocks, right? And here, because it is a sector focused approach and fund, so therefore macro bucket becomes interesting, because there at a very simple level, if I was to explain, it basically is mapping which industries or which sectors do better or worse at different points of time in the macro regime or macro cycles. So it has that mapped, and as per how that is evolving, it is able to change the weightages in the different sectors that will do better in those cycles. So these are the 5 buckets, and again there is some alternative data obviously, like in momentum bucket, as I said, it's more industry momentum and industry seasonality. So even a jobs data kind of thing, which we've explained in the past as being an interesting alternative data which has had good impact for India and for global portfolios. So that jobs data again will go into a momentum bucket, for example. So there is alternative data. It is lesser than the Flexi Cap, because you can obviously get much more alternative data at a stock level.
Yes.
But it still is there in the bucket.
Fascinating, Rishi. So I think the macro bucket is completely new when it comes to the sector rotation fund, and the way you look at data also, like I think a lot of trends which you mentioned at a sector level make more sense in a sector rotation strategy than a stock picking flexi cap strategy.
Correct.
Rishi, let's do a quick side by side comparison. Like I'm going to give you a metric, and why don't you tell me what is the answer for it in the flexi cap versus the sector rotation?
Sure.
So let's start with number of stocks, like the range. What would that be for flexi cap, and what would that be for sector rotation?
Yeah, so Flexi Cap overall can be a very broad range at extremes. So like 100 at the lower end, 160 at the higher end.
Yes.
But as we've seen in the last 3 months, it's sort of hovering around 140 largely. So I think 130 to 145 is majority of the times going to be the range.
Okay.
In this fund, it is on an average around 220 stocks. So it is more diversified than Flexi. But the important point to remember is that it is the outcome of the sector selection.
Okay.
So what we are doing here, I explained the process on the sector alpha scores that are coming out.
Yes.
Then post that, the risk scores again for the sectors and the stocks and the liquidity analysis and cost analysis is similar to Flexi. But then the overweight, underweight is coming at a sector level, right? And then what is happening is that all the stocks in that sector, the model is allocating to in the ratio of their free float market cap.
Okay.
Right, to make it most relevant. Free float market cap makes the most sense. But at that level, there is no stock selection that is happening. And which is why we said that, 90 to 95% of the alpha will obviously be driven by sector selection.
Yes.
Because stock selection is limited to, very small stocks getting eliminated just because we don't want a very tiny weight or something in a very liquid stock, etc.
Got it.
So majority will be sector selection because we are not going into stock selection at all. Over time, we may bring that element in. But right now, we want to be very clear that Flexi Cap is your stock alpha and this is sector alpha, and therefore we've kept the process that way.
Got it. So Rishi, the next metric which I want to ask you about is the rebalance frequency. I know you've mentioned this, but like if we get a side-by-side comparison of the rebalance frequency, Flexi versus sector rotation.
Yeah, Flexi is weekly.
Yes.
And as I said earlier, because largely driven by the alternative data, which loses its importance after a week. For sector rotation fund, it is monthly because sector data is largely monthly and longer time frames.
Intuitively makes a lot of sense as well. So what about the churn of the portfolio. Can you talk about how would the churn of the Flexi Cap portfolio look vis-a-vis the sector rotation fund?
So over the year, it is actually interestingly quite similar.
Okay.
But for Flexi, the numbers are on an average 3% weekly.
Okay.
And again, remember it's an average. So sometimes it will be 2, sometimes 1, sometimes 4 and 5 also. But average is around 3% weekly, which means on an annual time frame around 150%.
Okay.
For the sector rotation, again, it is 12 to 15%. Again, broader range would be 10 to 15%.
Okay.
But most points in time, 12 to 15%. So again, it would be in the 140, 150, 160% zone over the year because of the monthly rebalancing.
Got it. So the frequency is different, but you're still going to see the sector rotation fund try to capture small alpha, given that it is a systematic strategy. It's going to be benchmark aware, and it's going to have a lot more churn, which is controlled by cost, is what I took away from.
And again, the active risk, is going to be very controlled as well.
Can you give us the figure for active risk? Like, what would you think Flexi versus sector rotation?
That will be similar.
Okay.
Because the whole goal for us at JioBlackRock is that the first few active funds that we bring out, we are able to control that active risk to that 3-4% kind of max active risk number.
Okay.
We may start small depending on the period. Like, for example, budget is just around the corner.
Yes.
Obviously, we'll be starting going live post that because the NFO is on till 9th February. But assume we were to start today, then, for the first few days, we would have probably started the portfolio at a slightly lower active risk.
Okay.
And then once the big event is out of the way, then have gone to full risk. But even then, it would be on the lower end 1.5% and then the higher end 4%. I think that would be the very broad range, which is not very different from Flexi. And on the higher end, 3 to 4% active risk, which again is very different from the market because usually those active risk numbers are much higher for the majority of the industry.
A fundamental fund would have bigger bets, bigger deviations, bigger active risk and more volatility. Rishi, can you also talk about sector bounds for the Flexi Cap versus the sector rotation? Like, what is the sector caps you've kept in these two strategies?
Yeah, so for Flexi, it's at a wider level ±5.
Okay.
But it virtually never goes there. So for all practical purposes, it's ±3.
3%, okay.
For sector rotation, it is ±10.
Okay.
So
Very
it is
different.
much broader, and it's again to do with the fact that we are focusing on sector specific
Allocation,
alpha.
yeah.
And therefore the weight changes have to happen dynamically at a sector level, and you therefore need to give it more room to change, otherwise it won't end up driving the alpha that you want to.
Very interesting, Rishi. And at a stock level, I'm guessing that happens only at the Flexi Cap fund. It doesn't happen at the sector rotation fund. Rishi, can you tell what should an investor's expectation, an investor who invests in the sector rotation fund, what would his experience be like and what should his expectation be from this particular strategy?
Yes, so risk I already mentioned, active risk would be as low as 2, 3, 4%, on the higher side 4%, and similar to Flexi. On the return and alpha side, again, the goal is to outperform the benchmark, which is Nifty 500, again, in this case, driven by SEBI regulations.
Yes.
To outperform that by a few percent. The backtest and simulations show around a 3.5% annualized alpha, and the backtest period has been 2017 to 2025, just because a lot of sector data was not clean before 2017.
Okay.
3.5% is at a gross level. The fund TERs and expenses are again low, similar to Flexi Cap at 0.5%.
It's the same, right?
It's the same, and it's on the lower end of the industry. So if I take that away from the gross numbers, then that 3.5 becomes 3%.
Yeah.
And as you and everyone else who's heard me on this podcast or in other forums in the past would know, that I have a standard discounting mechanism of, eliminate another 20% or so. Just because it's a simulation, these are new markets, even though obviously BlackRock runs a very, very robust process, as robust as it can get globally. So ideally I should be discounting it lesser, but it's just something from my long experience that I've learned to discount by a larger number just to be a bit more conservative. So I think if we can, in the very long run, target that kind of alpha, then it, with that kind of low active risk, then becomes a very attractive proposition for investors.
And that's very difficult to achieve, right? Like when you think of an 8-9 year period to consistently deliver alpha and outperform the benchmark.
And while it looks small to a lot of people, because in between last few years had been very good, apart from the last 1.5 years, which is not, I think, which has brought a lot of people back to reality.
Yes.
But because before that, 4-5 years are very smooth and very strong. So people forget, but you're right. I mean, if you look at a trailing 10-year period, then outperforming by 2.5%, 3.5% is would put you in the top 3-4 funds in any category you look at.
Fascinating. Rishi, and now, let's move to what most investors have in question. You have a Flexi Cap fund. Now you also will be having a sector rotation fund. Both are systematic funds, both are rule-based, both are data-driven. Now, as an investor, how do I decide on allocation? Like, do I pick the Flexi Cap fund? Do I pick the sector rotation? Do I pick a combination of these two? Can you throw some light on
Sure.
how does an investor go about picking the right systematic strategy in their portfolio?
Sure. No, so this is a great question because I think it matters even for like first-time investors, right? As we discussed some interesting stats that we already have of first-time investors. So, we've launched funds at JioBlackRock in that manner where, first-time investors would invest.
Yes.
Right? Starting from liquid fund kind of cash funds. Because if you're moving from FD, you'll first move to something like that in a mutual fund. Once you have that comfort, then you will look at equity funds where you'll first look at equity index funds, so which is why we launched index funds. Then you will go into a stock alpha focused fund, which is where Flexi Cap came in. Then you would go to a sector alpha to get the diversification. That is where this sector rotation fund comes in. So for investors, who are either first time investors or have invested very recently into equity index funds or their first sort of stock alpha focused funds, I think for them the next logical step is to look at the sector rotation fund rather than having many more funds on the stock alpha focus side. But if there's a fully first time investor again, then maybe he starts with index or Flexi Cap before this.
Got it.
But anyone who's done equity index or Flexi Cap should look at this fund. And then all other investors who have multiple funds across different categories, there I would say that obviously reallocating some of that or allocating fresh money to a sector rotation fund, because it's giving you a very different source of pure alpha. As I said earlier, that sector driven alpha is less in terms of frequency in the funds that are available in India. So therefore it becomes something that most people should look at.
And I think another use case for this personally, like what I feel, Rishi, is that investors who have a fundamental sector rotation fund, this complements that as well, because like when you even think the same thing for the Flexi Cap fund, when you already have an existing portfolio of 3 Flexi Cap funds or 2 Flexi Cap funds, why should you add a systematic strategy?
Correct.
So I think that becomes another use
Yeah.
case.
So being non-overlapping, being non-correlated, being a very different process, not having key man risk, all of these are very different from a traditional fundamental approach, and therefore that complementarity automatically comes in. So that complementarity and portfolio asset class diversification obviously helps in, like I said, most portfolios.
Yes. And how does combining the Flexi Cap fund with a sector rotation fund change the risk profile of, the combined portfolio versus single funds in terms of, say, information ratio, drawdown, customer experience? Like, as an investor, what happens when I combine both funds?
Yes, so that is a very important point, right? So the correlation of holdings and the correlation of returns of both our Flexi Cap and sector rotation fund. Obviously, sector rotation fund is not live, but based on the simulated numbers, and we are looking at all this data, remember, on a daily level, right? So obviously going into a lot of granularity and not looking at just monthly numbers, which can hide a lot of things, right? So even at that daily level, when we look at the correlations across holdings and returns, then the average correlations come to very, very low numbers. It's like 0.1 and around.
Rishi, can you explain what that means, like for our listeners?
What that means is that the good and bad patches that both the funds have, will not move in tandem.
Okay.
They will happen at different points in time. It doesn't necessarily mean that obviously they're going in different directions. That would be negative correlation.
Okay.
But if it's a long equity fund and over time equity markets are going up and both have to, give you returns, then obviously both are also going up over time.
Yes.
So they will have a positive correlation therefore. But that positive correlation, like the example I gave, was on an average 0.1 over time.
Okay.
Which means that it's 10%.
Okay.
In that sense, it's much easier for a lot of retail investors to understand at a percentage level, which means that 10% of the days only they were sort of, moving in the same direction. So you can move from point A to point B, both be up, but be going in different directions while moving from point A to point B. So that is what this achieves, and therefore it is important from what you mentioned, the risk and the information ratio, risk reward return numbers, because every long only strategy will go through a tough patch where it has negative alpha, which we are trying to control by having low active risk, but we'll still have it. So if both of these funds have that bad patch or the higher end of that active risk at different points in time, it is very easy to understand that when we combine both, then that active risk number will drop further. And that's exactly what you see when you combine both the numbers, that your overall active risk numbers are slightly lower, your information ratio is much higher.
Okay. So your active risk reduces, your information ratio increases, and what happens to the drawdown profile?
Drawdown profile also on the margin slightly reduces, but they're anyway close to each other, so there's not a meaningful change, but it's slightly lower as well.
Fascinating, Rishi. Rishi, and what gives me comfort, I know that your fund is, the sector rotation fund is not live yet, but the back test is rule based. It is, it's not based on, there are no biases which crept into the back test, because it's not dependent on a fund manager's decision what you would have done.
Correct.
So that gives comfort to an investor that whatever you've shared with us actually intuitively makes a lot of sense to me, because of the fact that it was driven by a particular process. It was process oriented, and that's what led to this outcome. Rishi, final question. What are you looking forward to next? I know it's like, I think, and the reason why I asked this is, as the CIO, I did read a lot of announcements in terms of, SIF strategies which you're looking at. Can you talk a little about, what's next for JioBlackRock beyond mutual funds, beyond the systematic world?
We recently got our NOC from SEBI for SIF, which was very encouraging. And the initial product, the strategy is being fleshed out as we speak. We are like 90% ready, I would say. But as we all know, SIF almost like another mutual fund because of different branding, logo, different operational processes. So it'll take us a few months to start. But in the new financial year, at some point in the first quarter, I think we should be able to plan the first SIF and then a few more down the line. That is interesting. We think we can offer a very differentiated risk reward profile there, which can be interesting for investors. And that is what we are always looking for, as those differentiated sources of alpha and better risk adjusted return profiles. And then of course these are new categories, but also ETFs. Obviously BlackRock globally is so big on ETFs. Here, it's very easy to launch an ETF, but we want to do it in a very scalable manner. So what, systems and processes that BlackRock has used globally for scaling up, what of that can we get? Obviously getting everything may not be feasible, but at least starting to do it in phases, so that we can launch many ETFs, and if they start scaling up, we don't run into any operational problems. So there is a work stream working aggressively on that. It'll take us a bit more time, but we want to do it in a fully robust and scalable manner. So whenever that starts, later in 2026, I think it'll be more in the second half, but whenever it starts, post that you will see a flurry of potential ETF launches from us. So that is the other exciting thing. And then on the regular mutual fund side, of course, more active funds being launched as well. Apart from a factor suite of indices is something, whether we do it on an index fund side or an ETF side, again later in the year we'll think about. But both on an active side and a passive side, again having more factor specific stuff like we discussed earlier, that now we will have stock and sector specific alpha focused products, but factor remains the third thing, so that also we'll bring over time. So there's a lot to happen over the course of 2026.
I think very interesting times for JioBlackRock and for investors as well to get such differentiated offerings. And what I really like is that you build a value proposition before you launch anything, keeping the end customer in mind, evaluating what is already there, how are you different, and what value it adds to an investor's portfolio.
Perfectly.
Rishi, thank you for being so generous with your time.
Thanks, Rahul.
And to our listeners, do visit our website www.JioBlackRockAMC.com.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.